Hey everyone, welcome to the podcast today. We're talking about the First Home Super Saver Scheme. I'm joined by Vince Scully, good friend of the podcast. Hey Vince, how are you?
Great, Glen. Good to be here.
Now, this one, it's probably worth, after you listen to this, if you're in the car or wherever you are, to go back and watch it on YouTube, because I've got the iPad and we will be drawing some examples. And hopefully by the end of this, we will be able to cover a heap of questions. Now, some of the things we're going to cover is...
So what are we talking about, Glenn?
The First Home Super Saver Scheme. FHSS. The scheme isn't part of the acronym. It's just First Home Super Saver.
Ah.
Now,
so it's not like an ATM machine.
No, that's right. These are the questions we're going to be kind of answering. Is it mainly to save money from investment returns, or is it purely a tax play? What happens if you change your mind? So you put money in and then, oh no, crap, not buying a house, I'm moving to Prague. What happens if your super account decreases in value? What happens if the super account increases in value? Is it worth setting up another super fund to, I guess, quarantine that money? Can couple use it to save? Can we save, as a couple with our supers? Are there any ramifications for HEX or HELP debt? Can I put my superannuation guarantee towards it? Because that's a question that comes up. And any other considerations. Now,
great questions.
There are some good discussion points there. I think what I want to do first, Vince, is just unpack the basic concepts of how salary sacrifice works. Because if we understand the baseline concepts of salary sacrifice, it will become apparent the Super Saver Scheme.
Yep.
So in this example, this individual is earning 70 grand a year. They get paid in, and then income tax of 15 grand-ish comes out, which leaves them the net pay in their bank account that, they can spend on whatever they want. Their employer pays them 9.5% super on top of their 70 grand salary. And the reason we've used 70 grand is that's basically the median income of the My Millennial Money community. So
it's not far off the national average either.
Yeah. So their employer will pay their super fund $6,650. However, every time you put money into super, the government will take a 15% contributions tax.
So when you see your statement, this is not a fee. This is the government putting their hand in your pocket.
Exactly.
But the great thing about it is that 15% is less than 34.5%, which is what you would pay if you took it in cash.
Exactly. So as you can see here, the actual amount that lands in the super fund is about $5,600. A couple of things you need to know about the First Home Super Saver Scheme. Firstly, the amount of pre-tax money or concessional contributions at 15% that can go into a super fund each financial year at the time of us recording is $25,000 per year. So we can't put in more than 25 grand as a combination of the employer contribution or the additional salary sacrifice that we use to save for our first home.
Yep.
The other thing in
relation...
relation...
Still a fair bit of money, though.
It's still a fair whack of money, and most people don't get there because it's so much bloody money.
Yeah. Unless you earn $250,000.
And you got some money laying around, yes. Now, a couple of things. The maximum that you can put in to super to save for your home deposit per individual is $30,000 over your lifetime. However, you can't do more than $15,000 per year.
Correct.
So if this individual, if we go to the next slide, salary sacrificed $250 per fortnight into super or $6 grand a year, you can see that the 6,000 salary sacrifice and the 6,000 SG contribution, it's $12,650.
So plenty of headroom in the limit.
Plenty of headroom in the limit. And then we know ordinarily, because our gross income has dropped to $64,000, we're paying less tax outside super, which means we take home less now. And there's a thing here that says withdraw $4,800. We're going to get to that next, but it's just so important to understand how salary sacrifice works. As a little bonus, without confusing you too much, the government will allow you, if you do not salary sacrifice through the year, so we put a line through that, they will allow you to transfer, $6,000 at the end of the financial year into your super fund, or automatically transfer money into your super fund and claim that on tax manually.
And what that means in raw numbers is if you had $1,000 of potential salary, if you took it as cash, you end up with $655, or it could go into your super fund and be $850.
Exactly. Now, a couple of things to note just on that contribution, whether you salary sacrifice or put money in yourself and claim that on tax, the salary sacrifice, the net wash up is the same, but you have to wait until you do your tax return to get that money back.
Correct.
Whether if your employer does that, you get the tax back
Straight away,
fortnight or each pay cycle.
And it's also a lot less admin.
Less admin. So there are other circumstances where you might want to do it if you're self-employed or whatever your situation
you're
is.
Sacrificing a bonus. Yeah, lots of reasons why you might want to do it. But in terms of habits and admin, X dollars a month or X dollars a fortnight is the simple and easiest way.
Yeah. So the crude wash up of this scheme is illustrated here, and you've put these numbers together, Vince.
Yeah.
Talk to us about, you mentioned before, the $1,000 pre-tax. If you're earning between $49,000 and $90,000, you can use this slide, take a photo of it. Mm-hmm. If you earned $1,000, you would end up with $655 in your bank account.
That's right. Because the other 34.5% goes to the tax office via
income tax.
Medicare and income tax. If you get your employer to put $1,000 in your super fund instead of giving you $1,000 of pay, only 15% tax applies when it gets into your super fund. So $850 ends up in your super fund. And ordinarily, you wouldn't be able to get that back till you're age 65. The First Home Super Saver Scheme introduces an ability to take some money out. So it says if you've put in more than your 9.5% mandatory contribution, you can access this extra bit when you want to buy a house, a first home.
To live in.
And so the way that works is your $850, you can apply to get it out. So you tell the tax office, I want to take this out. They say that's okay to your super fund, and you take your $850 out and you pay, it gets added to your tax in the year you take it out.
As income?
That's right. It's added as income in the year you take it out, and you get a credit of 30%. And so that $850 would end up as $811.75 in your pocket, which is conveniently $156 more than $655.
Yes.
So for every $1,000 that you wash through your super fund in this way, you end up with an extra $156.75, which is a 15% return, which is better than the stock market does most years.
It's free money for the government towards your house. So what you need to know, if anything, if you're saving for a home, your first home to live in, for every $1,000 you save, you will get $156 more.
So what's not to like?
Well, we're going to talk about.
We'll come back to that in a moment. There are a few wrinkles in this.
There are. However,
but that's the principle.
Yeah. So the maximum you can really save is $4,700 in tax.
Well, the benefit. You can save $30,000, but the benefit of doing this is $4,700, which on $30,000 is quite a return.
Absolutely. So we talked about these at the top. Is it mainly to save money with the investment returns, or is it purely a tax play?
90% is tax play. There is a small investment portion, but primarily this is around getting a tax benefit.
Yeah. What happens if the super account I put $15,000 in and the stock market craps itself because all our super's invested in the stock market
Primarily.
and it drops to $10,000?
The scheme takes this into account by saying that you can take out what you put in plus a deemed return
A
of
nominal
3%.
benchmark. Yeah.
Now, that doesn't mean that your money actually earns 3%. It just means that if you put in $1,000, you can take out $1,030.
Or in my example, if I had a super fund with $5,000 in it, I put $15,000 in that year, which means I've got 20 grand. The stock market tanked, so that money's basically 15 grand's left in my super fund. I could still take that out. So I wouldn't have any super left.
Yeah. So in effect, your future self is wearing the ups and downs.
Yes.
So you can, if your super fund does really well, you still only get to take out your money plus 3%. But if it does really badly, you still get to take out your money plus 3%.
So yeah, if you do invest in a fund that increases 1,000%, you just got to enjoy that when you're 65 years old.
That's right.
Yeah. Okay, that's cool.
But it does have the advantage that you can actually have this money working harder and not have to worry about what the stock market's going to do on the day you want to buy your house.
Yes.
So your future self provides that buffer.
We'll get to change of mind a bit later, but I want to go to...
Yeah. But sorry, just before we leave that, if your balance somehow fell below your contribution, you can certainly take your balance out.
Yes.
So the floor is what your balance is. So if you started with 5,000 and put in 15,
and the market completely
fell by 50%, then you could only you're limited to your balance.
So you just close your account, basically, withdraw the account. Yeah. A common question: can couples use this?
Yep, two times one is 2. Each couple gets the same allowance. So for a couple, 30,000 a year becomes 60, but they have to do it separately.
Yes.
And the 4,700 benefit becomes 9,400.
Yeah.
But obviously they're kept separate because you can't have a joint super fund.
In the instance of a couple and a spouse earning a higher amount or a lower amount, so let's talk to a couple. There's one of the partners works part-time earning 30 grand a year and the other one earns 85 grand a year. We have to choose one account basically.
Well, generally, this scheme doesn't make salary sacrificing in general into super doesn't make a lot of sense if you earn less than $40,000 to $48,000, and that's because the tax benefit is lower. So if you're earning under 40,000, your marginal tax rate is 19%, and your super tax rate is 15%. So 4% doesn't really merit all the hassles to do this.
Yeah.
So you generally want to be starting with an income above 48.
Yeah. So I think even for people to have loosely in their mind, if you earn under 50 grand, have some caution.
Yes.
So just...
Yeah, you ideally don't want to end up with a taxable income below 48 when you're doing this strategy.
Yeah. No, that's a good one. So, yeah, if there was a relationship where someone earned 35 grand, the other one earned 85, and you had that spare 10, 15 grand per year...
You put it all in the higher
income earners. But if there was a couple and they, good cracking income, both earned 85 grand, we can say 15 grand a year, $1,000 a month each, or whatever that is.
Yep.
You can both pump each other's super and then apply.
As long as you both qualify individually.
Exactly.
So first home, buying investment property, buying a
house to live in,
and both being on title. Yep.
Yep. Sweet. Certainly you can use it as a couple. There's a question here. We've answered the SG 9.5. It can't be used.
It's only for extra contributions.
Yes. So if, if you put $1 extra in, you can apply to get the the dollar out, or a bit under the dollar, but you have to put extra money in. What if someone's got HEX or HELP debt?
Now, salary sacrifice doesn't change your HEX liability. So if you earn $60,000, you pay your HEX based on $60,000. The fact that you've chosen to put 5 of that into your super fund doesn't change that. Where it gets a bit tricky is that it reduces the amount of money your employer has to withhold. So they're going to withhold the HEX from your pay as if you were earning the lower amount, which means you will end up with a bill at the end of the year. It's not extra money. It's just dividing it into 2 pieces, the bit your employer withholds and the bit you have to pay in your tax return at the end of the year. Now, that's not a particular problem as long as you've got the money at the end of the year. So
if you're worried about getting an additional tax bill because of this, because your employer, it's not their problem, they're just withholding.
You've really got 2 choices to deal with that.
Yeah.
Either each month you set aside the amount of your HEX, and it's pretty easy to go on the ATO website and look up the percentage that applies to your income. So, let's say your HEX threshold is 8%, then you just need to put away 8% of the sacrificed amount, and then you'll have the money at the end of the year. The other alternative is to make the contribution out of after-tax money and then claim it as a deduction at the end of the year.
Yeah.
There's obviously a timing difference there that you got to fund the money till you do your tax return.
And I think it's important to note, Vince, that with taxes strategy, come 30 June, everything washes up the same amount.
It does.
It's just a matter of how you're making the cards fall throughout the year, and there will be a reconciliation.
Yeah. Personally, I like the habit of setting the money aside each month. So the salary sacrifice and then putting in a high-interest savings account, the HEX contribution.
Or you could actually tell your boss to actually withhold some more tax if
You
you
can.
actually didn't want to worry about if you can't control yourself.
Yeah.
Are there any other considerations that we need to talk about? I want to. There's
the big one that everyone asks is, what if I change my mind, or what if I can't find a house?
Yeah.
Or what if I move overseas? The decision you get to make is you can choose. So assuming you get to the point where you've made the decision, I don't want to buy a house, or I want to buy investment property, and I will therefore never qualify to take this money out. At that point, you can take it out and pay some tax on it, or you can leave it in and spend it when you turn 60. If you choose to take it out, there's an additional tax of 20%, which means you will be marginally worse off.
Yeah, so on the slide that we had up before, we'll pretend that money's already in.
Yeah. So on our previous example, we said $1,000 of salary got you $655 to spend post-tax. Salary sacrifice got you $850 in your super fund.
Yep.
And you could withdraw a net amount of $811. If you change your mind and pay this extra tax, you end up with $641 after tax, which is $14 worse off than if you'd taken the money as cash in the first place.
So really,
but in the meantime, it's been working away in your super fund.
At least growing.
Hopefully growing, but certainly working away. And so as an option fee, you're saying, I'm going to bet $14.
Well, that $14 worse off per $1,000.
Per $1,000, yes.
So if I go 14.25 times 30,
correct,
the maximum you would have to pay is $427.50.
Yeah.
So that's a pretty cheap insurance policy.
Exactly.
To get an upshot of tax savings and possible investment growth while saving.
Yeah. So your upside is $4,700. Your downside is $470.
So why wouldn't you do it?
So why wouldn't you do it? Well, you've got to qualify for it for a start.
Exactly.
So which means you've got to be buying your first home. And if you want to do it with your partner, you both have to be buying your first home. You do actually have to live in it.
Curly one that's a consideration. I think we need to understand the process.
Yeah.
And then I'll talk about a curly one.
Yeah. So the process is when it comes time, when you've saved enough and you're ready to buy, you write to the tax office. Technically, you go on your MyGov account.
But I guess what I'm saying is, Vince, to start this, you don't have to tell the government
that's
that
right.
you're using it for.
So all you've got to do
is put money in.
Is put money in.
And claim it on tax as a post-tax or salary sacrifice.
That's right. And then at some point in the future, you get to the point where you've now saved enough, both with this super money and your normal savings, or maybe a contribution from your parents, or maybe you win the lotto. You're now ready to buy. So you notify the tax office and say, well, that money I've been saving for a few years, I now want to use that. Please give me the paperwork I need to give my super fund. So the tax office will give you a determination which says, here's how much you can take out. And then you give that to your super fund, and your super fund then puts the money in your bank account. And you have to use it to buy a property within a period. I think it's 18 months.
Yes,
there's a
12 or
time
18
frame.
months.
Yeah.
And again, just if you Google First Home Super Saver Scheme ATO, the ATO website's in pretty
It's not
good
bad.
everyday language. Now, the curly one that I want to talk to you about, Vince, is this can get tricky if you're buying at auction.
Yeah. So that comes back to the order you have to do this in. So you have to get the determination from the tax office before you sign the contract. And you then have a period to spend the money. When you go to auction, when the hammer falls, you've got to enter the contract. So you can't wait till you win at auction to get this determination. And if you want to use the money as your deposit, you've got to do this far enough in advance. So because on the day of the auction, you're going to have to hand over a check for 10% of the purchase price.
Or pay penalty.
Well,
And that's what I mean. You've just got to line your ducks up.
so if you're using the money to pay your 10% deposit, you've got to make sure you got it in advance. And then there's that timing issues that, well, what if you lose at every auction you bid on for 18 months? So you do need to get the timing right. And the thing about auctions is you've got to turn up with the deposit on the day, which means you need cash. And so if your first home super saver withdrawal is your deposit, then you've got to get it long enough in advance, because it can take 14 days or more to get the money out of your super fund.
Yeah, I'm a fan of this scheme as much as it is convoluted way for the government to give people a bit of a tax saving.
I mean, the advantage of using this scheme from a government policy perspective is that it forces the individual to do something first.
And be active.
So if you just handed over the money, so if we gave everyone $5,000, it will disappear into the price of new houses pretty quickly, just like the first home buyer grants. All they really did was push up the price of houses. Whereas this way, it gives first home buyers a bit more oomph in their savings.
Intention.
And because it's over such a time, it doesn't flow straight through to prices.
I want to talk quickly about strategy. Now, I guess I've got a note here that just whatever you do, don't, even if it's a non-auction sale, don't sign the contract and then go to the ATO and say, I want my determination.
Yes, the timing is critical.
Because technically you're already a homeowner because you just signed the bloody contract. So your money's stuck in super, or you pay up to the $467 fee or extra tax.
Yeah. So timing is important. And because of the interworkings with your super fund, it's important to get professional advice.
Yep.
In fact, this is often a trigger for people to review their super. That, whilst you're starting to save, your super fund might actually not be the right super fund for you. So to do those, kill those two birds with one stone, review where your super is, and then put the stuff in place to get this all happening.
Yeah.
So get good advice.
The last thing.
And so just on the super fund side of things, when the money comes out, it comes out across all your investment options. So your super fund will prorate it across. So if you've got half of your money in balanced and half of it in cash, they will take half from each. So investing these contributions in cash doesn't actually save this problem, which might be a reason why you might want to choose a separate super fund to house these contributions. The downside of that, of course, is that if it's fallen in value, you then have to get money from your other super fund to top it up. So there's a bit of paperwork involved. So I don't see too many people taking that approach, but it sort of makes sense as long as you manage the fees. But it is important to get advice, and it's a good opportunity to review your super.
Yeah, and I did lose my train of thought before, but on the strategy piece, if you've got a $20,000 home deposit right now, and you are looking to buy within the next year, that money's in your own bank account. Remember we talked about you might put your own amount in super and claim it on tax. If you're under the 25K limit in this financial year, you can dump 15 grand into your super fund and claim that 15 grand on tax and get the tax back.
Yeah.
So I think all is not lost if you've got a lump sum of savings and you can straddle either side of the financial year. And if you're not buying before June next year, you might dump 15 grand of your savings into super before June.
Yeah, so you could put 15 in June, 15 in July, and take
Pull
it out in August.
30. Yep. So,
and whooshka, there's $4,700 for free money.
Yeah. So that's kind of this strategy play. It's like it's not don't have to drip feed it in. No, we can dump in 15 grand tomorrow and pull it back out. And if your deposit is only 15, well, actually, Vince, as an example, if you're buying a new property tomorrow and you've got 30 grand saved and you're good to go tomorrow, as in next couple of weeks, flush 15 grand through super.
Yeah.
There's a couple of grand in tax savings there. So why wouldn't you do it? So get advice, speak to your conveyancer. They might know a bit about the process. Speak to your financial advisor. As you said, Vince, it's probably a good time to review your super. And also you're going to buy a house, so make sure your income insurances are in place, your death cover and all that.
And remember, this is all in addition to all the other first home buyer benefits. So you can still get your home builder, you can still get your
state-based
FHOG,
grants.
You can still get your stamp duty exemptions. So now might be a really good time to think about this.
It's a great time to be alive.
It's a great time to be a millennial.
Well, Vince, thank you so much. And I hope that really explains to people in a simple way that we are just flushing money through super, a maximum of $30,000 over 2 financial years if you are doing it that fast, 15 grand per year, as long as you're under the 25K cap per year, including your SG, with a maximum of about $4,700 in tax savings.
Yeah, I'm not sure that flushing is the right word. Maybe washing.
Flush, wash, whatever. So there you have it. Thank you so much. You can, you can follow Vince on Instagram at Lifesherpa, and we're happy
and Facebook and Instagram.
And all that stuff.
LinkedIn.
Oh, what's that? All right, guys. Thank you so much, and thanks, Vince.
It's been a blast. Thank you, Glenn.
Bye.